So the Federal Reserve kept its rate right where it was, 3.5 to 3.75%. Fifth meeting in a row, no change.
And if you saw that headline and felt a little wave of relief, like, okay, rates aren't moving, maybe my mortgage stays put too, I get it.
That's the logical thing to think. Most people assume the Fed rate and their mortgage rate move together, like two hands on the same clock. They don't. Back in March, the 30-year conforming mortgage rate bottomed out around 6.15%. That was the lowest it got.
As of this week, that same rate is sitting at 6.94%.
The Fed didn't touch anything. Your mortgage rate climbed almost 80 basis points in the wrong direction. To put that in real terms, on a $400 loan, that's roughly an extra $208 a month. Over 30 years, that's about $75,000 in additional interest. And nobody voted for that. No committee gathered in a room and decided your monthly payment should go up. There was no announcement, no press conference, no one explaining it on the evening news. It just happened. And if you're a buyer right now, or you were getting close to locking in a rate, on a normal house, that's hundreds of dollars a month.
That's the difference between qualifying for the loan and not qualifying.
Between the budget working and sitting at your kitchen table realizing the numbers just don't add up anymore.
So if the Fed didn't raise your rate, who did?
The bond market did. The 30-year Treasury bond yield hit 5.239%, the highest it's been in 19 years. You'd have to go all the way back to 2007 to find a number like that. And the 10-year Treasury, which is actually the benchmark mortgage rates follow, climbed from around 4.5% in mid-June to 4.64% before the Fed even made its decision. The bond market moved first. It didn't wait for the announcement. It didn't care what the Fed was going to say. It had already made up its mind. And honestly, the way this works is simpler than most people realize. The government borrows money by selling bonds. The people buying those bonds look at the economy, inflation, risk, uncertainty, and they decide what return they need to hand over that money. When they see more risk, they demand a higher yield. Mortgage rates are benchmarked to the 10-year Treasury, but the final rate also depends on mortgage-backed securities and lender spreads. So the Fed can hold its rate perfectly still, and if bond investors get spooked enough, your mortgage rate goes up anyway. That disconnect is what catches people off guard. They watch the Fed announcement, hear no change, and assume the story's over. The story was already written before the meeting started. The biggest monthly payment in your life is controlled by a market full of bond traders pricing risk in real time, and most buyers have never heard of them and will never see their faces. The Fed chair, Kevin Warsh, put it like this at the press conference. His exact words: "Market participants are learning to play the ball, not the referee." The head of the Federal Reserve is telling you out loud that the bond market stopped waiting for his institution and started acting on its own. And he didn't sound bothered by it. He sounded like he thought it was working. See, without the kind of forward guidance investors got used to from previous Fed chairs, guessing the next move got a lot harder. And uncertainty by itself pushes yields higher, because bond buyers have to price in the risk of being wrong. So what is the bond market so worried about that it pushed long-term rates to levels we haven't seen in almost 2 decades? Start with a map. On February 28th, Iran shut the Strait of Hormuz after US and Israeli attacks. Roughly 1/5 of global petroleum consumption and 1/5 of global LNG trade normally passes through that single choke point. One strait, one closure, and a major share of global energy trade is disrupted. And the backup route, the Bab el-Mandeb Strait, is under Houthi attack. Both choke points compromised at the same time. Oil briefly went past $100 a barrel. Brent crude is still sitting above 92. Now, that oil price flows straight into the gas station, into the inflation numbers, into the model some bond trader uses to figure out what yield he needs. And that yield is what sets your mortgage rate. The chain from a closed strait to your closing table is way shorter than most people think. And this is the kind of risk you can't model away. It's not a cycle. It's a geopolitical event that could resolve next month or drag on for years. Bond traders don't know which outcome is coming, so they demand a higher return for taking that risk. Inside the Fed, the response to all of this was a fight. 3 officials, Beth Hammack at the Cleveland Fed, Neil Kashkari in Minneapolis, and Lori Logan in Dallas, voted to raise rates. 3 dissenters on a single decision. That's a signal. In normal times, you might see 1 dissent, maybe 2. 3 means the consensus is fracturing. Inside the building, patience with inflation is running thin. And Fed Governor Christopher Waller said this, and I want you to hear his exact words.
Sternly staring at inflation until it melts before our withering gaze is not an option.
He actually said that, and then he voted to hold rates steady. The guy who just told you staring doesn't work voted to keep staring. That contradiction, coming from one single official, tells you everything about where the Fed is right now. Hold too long and inflation may spread. Hike too soon and they risk pushing the economy toward recession. Before the meeting, roughly 30% of traders expected a hike. After the meeting, after the dissenters, after the oil data, after all of it, the CME FedWatch tool showed September hike odds jumping to 65.2%, up from 57.3% just a week before. The market now sees a rate hike as more likely than not. And if that hike actually comes, the short-term rate the Fed controls goes higher, while long-term rates and mortgages would still depend on how the bond market interprets that decision. So if you're a buyer sitting on the sidelines waiting for relief, you might actually be waiting for the opposite. The bar for a rate hike has dropped, and if higher energy costs start bleeding into broader prices, it could drop even further. The window that a lot of buyers assumed was opening, that rates would come down and make homes affordable again, may not exist. So if rates are already near 7% and another hike is more likely than not, what can you actually do right now? This is where I want to be careful, because there's no magic answer here, but there are real strategies, and every single one of them trades one kind of risk for another. Your job is to figure out which trade-off fits your timeline. First one, adjustable rate mortgages. An ARM gives you a lower starting rate, sometimes meaningfully lower, for a fixed period, 5 years, 7 years. If you know you're going to sell or refinance before that fixed window closes, the math can actually work in your favor. The risk is obvious though. If you're still in the house when the rate resets, your payment jumps. You're basically betting on your own timeline, and you need to be honest with yourself about whether that bet is solid. Second, temporary rate buydowns. This is where a seller or a builder funds a lower rate for the first year or two of your loan. A 2-1 buydown, a 3-2-1 buydown, it buys you time. If rates come down during that window, you refinance into something permanent. If they don't, you're back to the full rate. The catch is the seller has to agree to it, so it works best in markets where sellers are motivated, and right now, in some segments, they actually are. Third, paying discount points at closing. You pay an upfront fee and your rate drops for the life of the loan. Whether the math works depends on how long you stay. If you're in the house long enough to recoup that upfront cost, it pays off. If you refinance early or sell in 3 years, you basically threw that money away. It also takes cash at closing, which isn't nothing when you're already stretching for a down payment. Fourth, interest-only loans. These bring your monthly payment down in the early years because you're only covering interest, not principal. You're not building any equity, and when the amortization period kicks in, your payment goes up. These aren't widely available, and they need a stronger borrower profile. But for the right situation, they can work as a bridge. Now, you might ask me, is there any part of this market that's actually still working? And the honest answer is, there are pockets. Markets with homes priced below $300,000 are the one segment where demand hasn't really dropped off. Buyers in that range are still showing up, and new inventory is still finding takers. It's not a boom, but it's not the freeze you see at higher price points either. And that tells you something important. The market isn't uniformly broken. It's broken at the top, where affordability has stretched past what buyers can carry. Below that threshold, the math still closes. Look, none of these are magic fixes. Every single one trades one kind of risk for another. An ARM trades long-term certainty for short-term savings. A buydown trades somebody else's money for a ticking clock. Points trade cash today for savings tomorrow. Interest only trades equity for breathing room. There's no strategy on this list that makes the problem disappear. But there's a real difference between having no options and having options you actually understand. You can't control the bond market. You can't reopen the Strait of Hormuz. You can't vote on the next Fed decision. But you can control your strategy, your timeline, and which trade-offs you're willing to live with. And in a market like this one, that's not nothing. Honestly, that might be everything.